Hey, it's Lewis and welcome back to the channel, and in today's video we're going to be analysing Moody's stock. We'll be using TIKR terminal to go through the financials, and then I'll sit the cash flows into my DCF and we'll go into a fair value of their stock. Let's get straight into it. So who are Moodys? So Moodys Corporation, often referred to as Moodys, is an American business and financial services company. It's a holding company for Moody's Investor Service, an American credit rating agency, and Moody's Analytics, an American provider of financial analysis software and services. So the company itself is one of the main bond credit rating agencies alongside S&P Global. Company's been around for a very long time and is famous for the Moody's manual back in 1903, so a very long time. The company itself is listed on New York, on the New York Stock Exchange, and it is a component of the S&P 500 index. Now let's have a look at the sales per business for Moody's, and it's split into two different sections. So Investor Services in 2021 made up 64%, the Moody's Analytics made up 39%. Sales per region, so United States made up 55% in 2021, Europe, Middle East and Africa made up 30%, Asia Pacific 10%, then the rest of the Americas was 6%. I got EMEA right this time. I usually get that wrong, so I'm happy I've nailed it. Now let's have a look at the financials for Moody's, and as always we're on TIKR terminal, and we'll start with the income statement. So 5 years worth of data, and let's have a look at the first line. So revenue steadily increased over the past 5 years, especially over the past couple of years it's done some decent growth there, double-digit growth for the first time in a few years, 11% in 2020 and then 16% in 21. Yeah, that's fairly decent, that, isn't it, really, for quite a mature company. Gross profit margins wise, quite high for this business. Software, I'm guessing you'd expect high margins, which is something which attracted me to do this analysis, because I love high margins, I love software companies. And yeah, so let's just have a scroll down now. Net income to the company, yes, in the past 5 years this has more than doubled, so that's fantastic. Really good stuff. And you can see here the profit margins as well have gone up by a drastic amount. Yeah, fair play to them. 36% net profit margin in 21 and 33% in 20, and that's just increased on average nearly every year, so that's fantastic really when you look at it. You'd have to question if this is going to stay or not, and that's something you'd have to build into your analysis. You can see for the last 12 months the margins have come down a bit, so that's an indication that we've had a bit of a boom year and it's settling back down. That's not a problem, but you just have to make sure you know that going into the future. So let's have a look at shares outstanding. Are these going down ever so slightly? It doesn't look like we're doing many share buybacks. Might not be a bad thing. Let's have a look at how the capital is allocated in a bit. Balance sheet, let's have a look. So cash on hand has gone up slightly over the past 5 years. At least it's not gone down. Debt time and long-term debt's increased by a small amount, by about 2 billion. I wonder why we've done this. Could be many different reasons why, but if you've made an acquisition, for example, probably a good use of funds. But yeah, you want long-term debt to be going down over time, not up. But we'll see in proportion to the amount of equity on the free cash flow if it's a problem. My gut feeling is it won't be. Return earnings have gone up. Love it. Just simple little things like that. Look at retained earnings. How much profit have you accumulated over time? That wants to be going up. Simple as that. Right, okay, cash flow statement. So the main figure I look on here is cash from operations and capex. So these two figures combined make up free cash flow, or otherwise known as owner's earnings, as Warren Buffett would say. And we can see here the free cash flow. If you look at the capex, not much capex goes on in this business. Cash from operations is basically most of the free cash flow, so it's more than doubled in the past 5 years, which is epic stuff. Love to see that. Top of my head, the long-term debt was 7 billion, and their free cash flow is just under 2 billion. So it'll take them like 3 and a bit years to pay all the long-term debt off. So not much leverage in the company, just some quick maths. Let's see what we're doing with the capital. So they're paying dividends? Yes, they are. So dividend is growing over time as well. They are buying back shares as well. It looks like they issuing more debt than repaying. We've seen that, haven't we? And we'll see that later on. Ratios. So I like ratios because it tells a bit more of a story of the company's financials. The free financial statements are fantastic, but ratios, give a bit more of a detailed story of where the business is at. And what do I like? I like return on capital being high, and Moody's does this very well. In the high 20, it ranges from 30 to about 25, so still very solid. You'd want this to be in the 30s, ideally. Higher the better, but you can't knock them. 25% return on capital is very good. Gross profit, very, very similar across the board, very similar. The net income margins have going up as well. Likelihood here is if they've been increasing their debt, so that'll mean if they've issued more debt into the business and they're making a little bit more profit, it depends how much debt how much debt and equity they've got compared to the profits, and that's probably why the return on capital has gone down, but the margins and stuff have gone up, so if that makes sense. And we'll see how much debt they've issued overall over the past 5 years in my analysis section. So current ratio is way above 1. Dividend yield is 1% for your dividend investors. Not particularly great, but it's better than nothing, I guess. Debt to capital is quite high here at 70%, but at least it's decreased a little bit. So yeah, I'd like to look at this return on capital figure more. I wonder how they're calculating this. I want to tell you here. Yeah, we'll look at that another time. But yeah, so that's the TIKR financials for Moodys. If you're interested in using TIKR, link down below, click it, sign up to TIKR, have fun analysing some companies. Great bit of kit. They've got a global screener. You can track investing gurus / super investors. Really, really good stuff. I'm loving using this software. So yeah, link down below. Go ahead and sign up using my link. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you now there. Let's have a look at the genuine impact stats for Moodys, and we will start with the quality metrics. So it's currently ranking high on this metric, which is a good sign. Profitability very high, financial strength weak, capital allocation very sound. I think that's a good summary of what we've just seen from the financials. Financial strength weak, a little bit of debt, but the other two very sound. Makes sense. Value wise though, it's looking very expensive, so this is an unhappy start for Lewis. Everything's looking expensive or very expensive, so yeah, but we'll see my valuation to see where it needs to end up. Historical growth is all very high. That makes sense. For the past couple of years we've had some really good years, and overall metrics are looking, doesn't stand out at all, but the main things here is it's high quality business, but it's looking expensive. Now let's have a look at the analysis checklist for Moodys, and let's go through some brief info here. So market cap is currently $51 billion, so not the biggest company in the world, but it's not a small cap by any means. So PE ratio is coming 26, earnings yield of 4%. Right here, so first pillar, so I like a business to be profitable with high returns on capital using low leverage. In my view, these three elements are very important in terms of business quality. It might be very simple, but I like to keep things simple with my investing. It's got to be profitable, got to have high returns on capital, using low amount of debt to do all of them things. Return on capital 5-year average is 28%, so I think it's fair to say that this business gives a good return on its capital. 28% is nothing to be sniffed at all, nearly double from what I like to see. Gross profit margin, way above 40% at 72%. Software businesses do have higher gross margins. Net margin as well, 5-year average, 30%. Past couple of years have probably helped this a lot, but yeah, still a very, very good, very profitable business. Free cash flow margin as well as 26%, so close to the net profit margin in terms of you expect these figures to be similar over time. Current ratio 1.5, so we've got a lot of cash in the business, so we've got enough current assets to pay any short-term obligations, so more current assets and current liabilities, so that's a good thing. Cash conversion cycle is 87. This is like a bonus metric in my view, but it doesn't be below 60, but I believe it probably could eventually. Total debt to capital, this is a little bit of a concern here, so 70% total debt to capital, so it's looking like there's a little bit too much debt with Moodys. I mean, you're not going to have everything with a business. This is a little bit of a red flag, to be honest, and this would mean I'd probably want to buy it at a lower valuation, even if the business is very profitable. It does have a little bit too much debt. Proven ability to grow, all green, love that. There's not much to say apart from it's grown on revenue, net income, retained earnings and free cash flow. Great capital allocation, so the past 5 years they've issued 2 billion of debt. We saw that from the financials. Decreasing share count, ever so slightly decreased for shares. Grown the dividend, which is good. Good acquisitions, so this is another bonus metric in some ways, because it's hard to, based on numbers, what's been a good acquisition. Some obvious ones, such as Google buying YouTube, etc., Facebook buying Instagram. But gain on asset sales versus asset write-downs and goodwill impairment. If a business writes off goodwill and assets all the time, that means in the past they've made bad capital allocation decisions. And that's why I put this metric in. So for a company like AT&T, they would be negatively impacted because they're the worst capital allocators in the world in my view. Yeah, they definitely are. I'm going to do analysis on AT&T, you'll see how crap they are. Anyway, I better get back on topic, but quality score says 73%. So yeah, it's mainly the debt which is laying it down, but I'm going to hold hands up. Good quality business, so yeah, can't say much more than that. PE is 26 and price of free cash flow is 27, so buying at a fair price doesn't quite hit the mark yet. Current share price of $276 per share. If I, based on my DCF, $209, so it needs to fall by 24%. So let's have a look at my DCF now. And yeah, so I've taken my analyst estimates from marketscreener.com. Current fair value for the company of $209 for a 10% return. I'm thinking these might be a bit over the top based on what's going on in the world at the minute. So let me put a flat 2. I think 2 billion. Let's just say the company doesn't grow. Let's see what this does to the DCF. Right, okay, so this drastically affects the DCF. So sometimes analysts are very over-optimistic, and I think Moody's growing their free cash flow in current times like this is probably unrealistic. So if it remains flat, yeah, you want to be buying at even lower valuation. So what we're looking at, it has to fall over 50%. And if I'm going to be honest, I would rather wait for it to fall 50% and be conservative with my assumptions. Look at this, in 2020 we had good free cash flow, 21, alright, a little bit less is what it is. But in this current environment, it's more likely the free cash flow could probably go down. So yeah, if it goes down, then obviously the company's worth less. So I think it's worth being prudent, especially in current times. Yeah, so I've changed my mind and I thought, analyst estimates seem a bit daft. Let's put some just flat numbers in from, probably realistic, conservative, but it's better to be conservative than over the top. It's alright falling over 50%. So let's have a look at the stock price. What's it done over the past 5 years? When was it last at 137? So in the pandemic it didn't even get there. So last time was 2018. So yeah, who knows when it'll get there. But in my view, we've got to be conservative as investors and realistic with our numbers. Otherwise, we are just cheating ourselves out of our own money. So yeah, I think it's another waiting game with this company. So there we have it. That was my full stock analysis for Moodys. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.